Hello, everyone, and welcome back to another episode of WagMe TV. Episode 22 today. We're feeling 22 here on the pod. Raise one to
T
I guess
Swift.
Taylor Swift.
Yeah.
Taylor Swift causing the bull run. The
Causing
bear
a
market
bull run.
bull.
The bear market bull run. And that's what we're here to talk about today. As always, I'm joined by the absolute fellas, the doctor, Doc Mata, the NFT Lord himself, Alex Garcia, and the All-American, the one and only, Ev Smith.
Yes, sir.
How we doing, boys? Pretty wild week, huh? Like, we're just getting a crazy rally here, seemingly out of nowhere. Well, I mean, when we look at the fund flows, we know exactly where it came from. So we'll touch on that. We'll touch on that in a little bit. But wow, yeah, definitely a super eventful week, macro-wise. We had the GDP print come out. I believe, was that today or yesterday?
That was today.
That was
Yeah, this
morning.
morning, right?
Yep.
Yeah. So for anyone who wasn't tuned in there, US GDP here, let me get this pulled up. US GDP fell by 0.9% on a year-over-year basis in the second quarter. That marked the second straight quarter of negative GDP growth, which technically puts the United States now full-fledged in a recession. I know pretty much seems like we've been talking about this for a while and everyone was definitely feeling it, but now it's official. So that was one massive piece of news, right? On the flip side, I believe on Monday and Tuesday or Tuesday and Wednesday, the Fed had their July meeting in which they increased interest rates by 75 basis points, which was as expected by the market. The market seems to be interpreting their, like Fed Chair Powell's remarks as being pretty dovish, marking potentially a slowdown in the rate hikes, even though it's kind of weird. Like they essentially basically signal that they're going to keep increasing rates. Like, they didn't show any real signs in my view of really letting up in terms of like the rate hikes. But at the same time, they did say, I believe, that they were targeting a certain, I think it was like 3 to 3.5% by the end of the year, which I think the market basically interpreted as, okay, like if we're already at 2.25 to 2.5, then that just means that the rest of the meetings this year, if they were to get to 3.5, they would have to kind of slow down the rate hikes that they've been doing. Like they would have probably had to not do 75 month after month after month as they've been doing.
And
And so
just to clarify, I mean, they would still be raising rates there. It's just this historic run of 0.75, percent rate hikes that we've had over the last 3 months, and then the 50 basis point before that, they're going to be slowing that down. So basically what you're saying is we could have a 25 basis point hike coming up maybe in September, October, another 25 basis points, November, December, and that gets us to that 3% that people are targeting.
Right, exactly. Yeah, it's very tough to say. I think they're gonna wait and kind of see what the inflation numbers really say. But yeah, it seems like the market is interpreting this as a dovish sign that they're gonna kind of like let up a little bit off the gas in terms of the rate hikes. Now, I mean, they made it very clear that they're not gonna stop, right? So that's definitely something to keep an eye on. And obviously, as always, got to keep an eye on the inflation numbers and everything. But yeah, definitely just a very, very, I don't want to say chaotic, but kind of crazy week in terms of macro stuff going on. And then you pair this seemingly bad news in terms
Yeah.
of rate hikes and, the US being in an official recession. With the fact that markets have been rallying the last few days, right? So what do you guys kind of make of that whole situation?
Yeah, I mean, it's very interesting, and I think I sent you all a message in our chat. It's like, can you imagine, 6 months ago, seeing like 0.75 basis points as a bullish sign, right? Where we're going to actually try to go up from that. I think it's a very interesting thing, and especially like you mentioned, right? We're seeing a little bit of that bull run in a bear market, right? And it seems like it's coming at like kind of an odd time, right? It just feels like it's a lot of bad looming macro clouds, right? We're in a technical recession, though I know the Fed, the administration, they're not really calling it a recession quite yet. They're kind of trying to change the definition. They're saying we haven't seen the layoffs that we typically see. We haven't seen companies closing like we typically see, right? So they're kind of approaching it from a different angle almost. But when we look at it from a technical definition, right? 2 quarters in a row where GDP is negative, right? It's a technical recession. So I think it's interesting. It's something that obviously we all need to keep in mind every time that they have these FOMC meetings is really just what are they saying and in between the lines, right? So I think Powell said something like, though another unusually large hike could happen at our next meeting, this is a decision that will depend on the data we get between now and then, right? The next meeting is not till September, right? So that's definitely not even going to happen until then, right? So I think that allows a lot of the short-term traders to be a little bit more bullish in the short term, right? So start to push up some of these markets as well. But it's also, I think, why it was interpreted a little bit dovish, because the question being, okay, now that we've seen that we're in a technical recession, what do inflation rates look like? What are they actually going to do at this next meeting, right? So I just thought it was really interesting all around, just the different news points around it, the different frameworks that are working on with it, and how the market's really trying to deal with it and predict it. But I don't know, it feels really like there are just a lot of macro looming clouds that are going to prevent us from like doing a full bull here. So it does feel a little bit like a bull run in a bear market. So
And
I don't
it's
know. That's
almost
just my
like we've
thought.
kind of like level set a little bit, where people have come to the conclusion that we've gotten through these 4 different hikes. We've got, massive losses in crypto, but also significant losses in the indexes. And, people are looking at like, we've kind of gotten past this last Fed meeting. We've got a little bit of a break, like you're saying, Mata. And then from here on out, it's really a question of where does the Fed want to go? And what's the data that is going to be driving this. There was a lot of stuff that came out this week, whether it was GDP, I think PCE came out, still unemployment talk. But yeah, so I mean, we had Q4, the GDP in Q4 of 2021 go up 7%. And then in Q1 we had a drop of 1.6, and in Q2 this year, this most recent a GDP number was 0.9. So, it's kind of crazy to think about the rally we had last year, how significant a 7% increase in GDP is compared to, a 0.9, which kind of like hints to the fact that, yeah, maybe this could be a technical recession. Maybe this isn't, the biggest deal that we're in a full on recession, just because, unemployment is still at 3.6%. That's 4 months straight of 3.6%. I think PCE came out today and it was right around 7.2, which was the exact same that we saw in Q1. I think core PCE, which is just another like inflation number metric, was 4.4, 7.1 non-core. So I think there's a lot of stuff, a lot of numbers that held pretty steady through this quarter, compared to last quarter. And it's really a question of like, what industries are getting affected the most. And so when you look at consumer goods industries like Target, like Walmart, these were both companies that had enormous inventories at the end of 2021. They were buying a ton because they needed to stock up with the slowing supply chains. And we saw in Q2 here that they stopped buying. And so when you look at the GDP number, there's probably a couple tails in there. But if the retailers would have continued to buy like they did in 2021, we actually would have had a positive GDP number this time around. So, yeah, it's two in the negative, but 2 quarters in the negative. But there could have been changes by retailers that would have made a difference. So Yeah, I don't know.
I think a
fair.
big thing is people are comparing it to 08,
Yeah,
I
that's
think a
fair.
big thing is people are comparing it to 08, right? And it's
Right.
certainly not 08 drastic levels, at least at this point, right? And I don't know. I think one of the biggest things that crashed there was the real estate market, right? I haven't really kept too much of an eye on that. I don't know if all of you have an idea of what that looks like, or if that's been crashing a little bit, or if it's kind of been staying steady.
It's definitely
That's-
starting to teeter. We've definitely seen, and so I might have some more on this, but yeah, it's definitely starting to come down. Like we've seen, like housing prices in some areas fall 20-30% already. It really depends on the market. Like Utah, for example, is going to be a little more insulated from that because of how, I mean, they have one of the lowest unemployment rates in the entire country. So, and in terms of like average income or median income per household, so like they might be a little bit more insulated, but places where like it just skyrocketed over the last 5 years and like not necessarily as much of a foundation to hold it. I think that we're going to see some rapid declines in housing prices.
Yeah, it always starts to show up when, listings start going up and actual purchased homes start going down, right? And so that's what we've kind of been monitoring on this channel for the last maybe couple of months or so. And so to Garcia's point, we are seeing some cracks in that in the housing market. I do think like it hasn't gotten like to a severe point, but also we all know that the housing market is, it takes time, right? It takes time to kind of shine through there. And so it'll be interesting to keep a pulse on that. I think if we do see something like extremely drastic, that would definitely be like a bad sign. I think the one thing that's missing in this recession that we're in, like, and the reason why it doesn't feel like in the previous recessions, maybe like way more drastic, right? The reason why it doesn't feel that drastic now is maybe partially a little bit of what kind of Evan was alluding to, where it's like, okay, we just had such an insane bull run that it just almost feels like we're just coming back down to earth a little bit,
Right.
right? Like that was just completely unprecedented, and now, sure, we did have two straight quarters of negative GDP growth, but at the same time, it's like we had one of the most insane years ever in 2021, right? So a little bit of it is that. The other thing, and I think I've brought this up to you guys in the past, is the really bad recessions happen when mass amounts of defaults happen, right?
Mhm.
And we haven't really seen that, right? Like maybe a little bit of cracks here and there, right? In the crypto market, that's where we've seen the mass defaults happen, right?
Yeah. No bailouts there.
And the crypto market just simply wasn't big enough to take down the entire financial system like the housing market was in 08, right? It's like those sorts of mass defaults, and like that's not to say that it couldn't happen in the future, right? Like it very well could. And so that's something that we kind of need to keep an eye on, because that's the type of stuff that really causes like going from a recession to like borderline depression, like where companies just simply don't make it out, right?
Mhm.
And that's where you start to see a ton of the layoffs and like all of that stuff happening, right? Right now, the layoffs are happening just because of like slowdowns and people like cutting cost. But it's different when the layoffs are happening because businesses are straight up shutting down, right?
Yeah. I think another note on that too is, maybe layoffs aren't happening right now, but with the amount of turnover that companies have had, like in their employees, they have a lot of backfill, a lot of like headcount that has not been hired into. And so another way that they can do it is just by cutting that headcount. With so
Mhm.
many people leaving a company, there's open positions, just no longer allow hiring back into those. And so we could be in a period here where that's happening. And then maybe next year we'll just have to see how it goes, and layoffs could continue to happen. But for the most part, outside of maybe tech, I think is, growth is really seeing a lot of layoffs lately. Outside of growth, I feel like I haven't heard of a ton. I know like this week a few automakers mentioned that they were laying off, but outside of maybe those two areas, I haven't really heard of like large layoffs in the workforce.
Yeah, it'll be interesting to see because I think a lot of those companies, are still need to like basically what's going to cause them to lay off people is their operating costs just getting way too high, right? And so I think
Yep.
some of the lagging effects of the interest rate hikes and also the lagging effects of production costs from inflation, maybe we'll see some more layoffs come down the line. But back to, I just wanted to quickly, because I found a graphic to Zoe's point where we're at in terms of current supply of homes. And so we've basically like just at the beginning of this year, the last 6 months, we've basically just like skyrocketed up basically to the same levels we were at just post 2008 recession. So it'll be interesting to see kind of how that affects, the housing market. Because I mean, basic economics, right? More supply with equal demand obviously causes lower prices. But
yeah, I mean, prices will for sure have to come down there. There's just no other way, right? And I think we've mentioned this in the podcast before, is like sellers are always reluctant. They're always like reluctant to decrease the price. They think we're still in whatever the environment that we were 6-8 months ago. And so it takes a little bit of time for them to come to the realization that, things have changed, right? Which is why it tends to like lag a little bit. A couple of things, I wanted to pull up a couple of charts too, or a couple of things that I think are pretty important to watch. First is crude oil, right? We've discussed this in the past. This is like a massive indicator for like inflation numbers, right? Just because crude oil is essentially an energy in and of itself is like an input cost in almost everything. We almost look we're at like a technical resistance. If you come back to like February-ish, like the last 6 months, we skyrocketed up to like 120 a couple of times, but we've come back down and we're hanging in this range. What I'm curious to see is like, are we going to bounce off this and head back up? Or are we going to break this line and maybe come down here in 70s, 80s, which would be, I guess, like the next like from a technical standpoint. If you look at the 1 week chart, it even stands out even further, right? Like this is going back, the last 5-ish years. Like we've just shot up so fast here since late last year. And, I mean, we talk about it all the time. Like what goes up really fast must come down at some point. So it's a question of if this is going to continue higher, or are we going to get the, supply side a little bit more figured out? Are the producers going to end up producing a little bit more? And we're going to see this come down back into this $70, $80 range, which I think the majority of the global population would be very happy to see, to say the least.
I think it's difficult though, just because of how expensive oil and energy in general are in Europe. Like, cannot overstate what the Ukraine war is like, the pressure it's putting on these prices, and that's something that until that is figured out, the global crude oil, natural gas, all of those different, natural resources, the balance of those prices are gonna, be fluctuating like crazy. It's just something where like there's a ton of supply constraint that we didn't see 2 years ago or a year ago. So I think it's something where you could put TA on that chart, but at the end of the day, like with that type of macro event happening, you just never know where that price could go,
It's like a supply shock that we always talk about in Bitcoin, right? I mean, it's the
Right.
same thing. Obviously, with Bitcoin being this is your core supply and nothing can be generated from that. It's still the same concept with oil. And I think that's a great point. Like it feels like a lot of the bullishness and everything that's been happening in these markets have been very like US related, like, oh, what's going on? Is it recession? All that. There's a lot going on still that we've talked about in tons of our episodes, right? Like Evan mentioned, the war in Ukraine, supply issues, all that is still very real. And so it's something that we also have to keep an eye on, even though obviously the US is kind of the driver of a lot of what's going on. I feel like that's one thing to keep an eye on. I think another thing that's been, at least for today, that was driving a lot up was, Apple beat earnings. right?
Mhm.
Amazon gave good guidance and they had a revenue beat, right? So, I mean, you got these big tech companies that were supposed to be doing terribly. They're coming out and doing fairly well, right? I guess my one question, I don't actually know the answer to this, is like, where is the big money? And we'll get into it with the digital asset funds that we typically go into. But I know when we're talking about big money, we're talking mostly about bonds, the 10-year yields, the short-term yields, things like that. And so I don't know, are you guys aware of like what's going on that front? Is there a chart we could pull up from that perspective? Is that yield curve still inverted there?
Yeah, I mean, we could definitely dive into the 2 and 10 year. Let me go ahead and pull both of those up.
That's a really good question, because I don't know like how we'd identify where the money is, because I kind of get the feeling that it's the big money is essentially in like very, very stable assets or cash, like at this point, kind of waiting for things to collapse. So I'm kind of curious that's kind of my feeling, but I want to know where it's actually at.
So maybe I'm wrong on this, but I was thinking big money would be in short-term bonds rather than the long-term bonds, so the 2 years. But maybe I'm just kind of off base on how I'm thinking about that.
Yeah, I think that's a question for our resident banker. So,
Obviously, in
thinking,
USD, I think you're totally right there, Sia. But if they were going to put it into anything,
Yeah,
it
you're
would
probably
be
right.
those short-term bonds that are actually doing a little bit better than the 10-year at this point. But who knows? They could have pushed into equities and everything like that over the last couple of days.
Yeah. So what is this chart here? Oh, this is okay. I see at the bottom. I was
this is the yield curve.
Okay, gotcha.
And so we've actually seen a really large increase in short term, and we've seen long term yields, kind of come down a little bit. Like 2 and 10 year have not been that significant. They've been hovering right around 3. But I mean, if we would have looked at a map or a graph of this, a month, 2 months, 3 months ago, we would have seen, the 3-month and 6-month yields, coming out from zero essentially. And that's just like a product of we're continuing through these rate increases. But we have seen a flattening of the curve, and I think it's something we've talked about in the last couple episodes that this is like a developing situation, and definitely an indicator for a recession that a lot of people consider pretty accurate.
Yep. And I think that can also be translated into risk assets and stuff too.
That's a great chart,
where the bet is, the bet right now is that there's gonna be rate cuts in the medium term, right? Yeah. So I mean, Armada, I think you nailed it on the head. It took me a second to figure out the colors here, admittedly.
Yeah,
but
they could have done a better job with that.
You're totally right. In the last 30 days, you're completely right that money seems to be flowing into short term, and
just makes it seem like the large investors are probably worried about inflation, right? And they're
100%.
obviously not seeing anything from that 10-year, right? I mean, that's kind of how I would interpret that. But what do you think?
Yeah, I mean, I think it's tough to tell. I think at the end of the day, it really hasn't moved that much. To me, in my opinion, when I'm looking at seeing a significant change in narrative, it's that 10-year going from a 3% down to maybe a 2%. When you see a change of a quarter percentage point, that's something that I feel like it's definitely, an indicator. It's a signal, but it doesn't like drive the narrative that we've got an entire pivot on our hands. But yeah, I thought I'd just show.
Hold on, can you pull that back up? I think I was turned around there a little bit because this
is cause for a little debate. Let's get it.
No, so
give
what
us a
you're
little
saying-
insight, Soham. What are you
I was
thinking?
just giving
Yeah.
conjecture, right? That was what I was thinking. I didn't even
Yeah.
know what these numbers looked like, and so
No, that's good.
here we are.
No,
But
no. So
I'm not
basically
the resident banker.
The 30 day, right? The 30 day, the 30 days prior
That's
was
this one.
lower,
Mhm.
and the yield has gone up, which means the prices of those bonds have actually gone down.
Right.
Mm.
If I'm reading this correctly, it is like the colors were throwing me off, but
They are really similar.
so basically the shorter dated bonds would have been selling off, while the longer dated bonds would have been getting bought because the yield on those has gone down. Right? The yield goes down, the prices go up.
Right.
Those
Right.
are inversely related, right? And if the prices are going up, that means people are buying those. I just like this graph is weird because the colors are messing me up. Like,
Okay. Well, let's go ahead.
like usually they like, I think on Wall Street Journal when they show the colors in terms of the price action, not in terms of the yield action. You know what I mean? So I don't know. It is it's an interesting thing to look at though. As we've all talked about before, like the smart money is in the bond market. And so watching the bond market is definitely like a very smart thing to do. And it relates very, very heavily with currencies. And, we've all talked about the fact that Bitcoin and the US dollar like go like hand in hand, right?
Mhm.
Right.
So
And I
definitely
think
interesting stuff to look at.
that seems like a great segue into, talking about maybe some Bitcoin TA and what the different graphs look like for Bitcoin over the last week. See, you got anything?
Good week.
For sure, for sure. Yeah, I have the daily chart up here. But we have our, similar to what we did last week, we have our Fed rate hike markings here. And we also have the 200 week moving average. So this tends to be a very, very intense either resistance or support. So like, for example, you can see like we fell off a cliff here, but it did like stutter, right around the 200 week. And then we get rejected here, basically rejected here. We come above it for a little bit. And yesterday, I honestly thought we were going to get rejected at it because I thought that we were going to get that recession confirmation today and then come back down here, like to this support, which is that's just what I expected. But obviously, like, I guess people like love that we're in a recession. I don't really get that, but I don't really understand.
You're telling me you're not loving it, Sia?
I'm not loving it, dude. My gas is $5.
That's the truth.
But yeah, so I think we talked about this last episode, but basically every single rate hike has been net zero or net negative in terms of the price reaction to Bitcoin.
We've seen huge sell-offs.
Yeah, so here's net zero, basically. Here's obviously net negative. Here's actually essentially net zero. We basically were at the same price when we had that last hike to now. And so like, I'm just kind of curious now that we have double the time, because this is a month span, this is 2 months. Now we have twice the amount of time to speculate on risk on assets. So I'm wondering if people basically say, okay, you know what? We're going to just totally bet on a slower rate of rate hikes, whether we get a 50 BIP or maybe we do one more 75 and then 50 in the midterm, like Soham was saying. But I just don't, and maybe this is something that Soham knows, but I just don't understand the play here to totally bet and speculate on those midterm, slower rate bips in between this whole 2 month period when we really don't know, what's going to be happening. But right now, in terms of just technical analysis, the key is staying above 22.5, 22.6, because that's where the 200 week moving average is. You can bet that if we drop below that, we're probably going to come back down here to like 21-20 ish range. But there's a lot of confidence now, especially since we're above that. But it's interesting to see that we're kind of replaying what we did last time, where we had 2 massive green daily candles and then a red one, and then we just start coming back down here. So it's really, really hard to say, but we're in a critical spot for sure.
Yeah, it
Yeah.
seems like the market is almost getting desensitized to the rate hikes in a way. I also
Mhm.
think that a
Mm.
lot of people are pricing in the fact that you know, like it's tough to say. A lot of people are thinking that like the worst of the inflation is in the rear view, right? With commodity prices coming down a little bit, with some of these factors that impact inflation a good amount coming down. I think that also has a huge impact into the price action of what's going on. Also, if we look at like all the indicators that we look at for the US dollar or the bond market, right? Like yields were ripping. The US dollar strength was ripping, right? Like all of those things had the biggest runs that they've had in years, right? And so a little bit of correction there could be happening, which would, lead to a weaker dollar, a little bit strength in risk assets. So yeah, I don't know what it is about the month of August too. I've always thought this, like, ever since I started following markets, like I feel like I've never seen like August is usually a pretty dead month. Like it's usually not very eventful, low volatility. Things
End of
kind
the
of grind.
summer.
Things kind of grind upwards. Everyone on Wall Street is on vacation, so it's like I don't know what it is about. Like I remember even when I was working, in markets, like August was just like a sleepy vibe, and the market would kind of grind upwards. There's also no Fed meeting, no like huge economic stuff happening, not like very, very low volume days. Like just
Mhm.
overall market is like pretty lackadaisical in the month of August. And what you end up seeing is like a lot of times it just kind of grinds upwards. And then September hits, everyone comes back after Labor Day, and then shit just gets real. So, I mean, that could very well happen this year too. Like we'll have to see. You make a good point. Like there's no Fed meeting or anything in August. So there's no like, unless something crazy happens in August, there's no like negative catalyst, right? Like,
Right.
Yeah, I'm just kind of curious. Like, I think that so we had a lot of like if we think about and Mata's going to get into the inflows most recently, but like if you remember what we were covering, like down at these low points, we had institutional buys coming in down at these lows. Like we had decent institutional buys, not like what we're about to cover, but we had some buying down here at the base. And what worries me is we're now approaching the most overbought point Bitcoin has been at basically since like April. So we touched this area of being overbought. So like 70 is overbought, 30 is oversold on this indicator. And usually you don't see Bitcoin go above this level because people just take profits. So like right here, we had that. And then also back in April before we had that kind of steep decline, there was some profit taking up there. So I just don't see why especially like some of these large traders, why they would risk Bitcoin going to like 25, 26 when they can take, I mean, this is if you're investing a solid amount of money, I mean, this is a 20, 30% profit take right here, so it's like, why would you let that slip? So I'm kind of curious to see if we can still take the momentum, but I'm not sure.
Yeah. And it's a question of, sure, they've got a 3% target. The Fed and Jerome Powell have a 3% target by the end of the year. But, is 3% going to be enough to really curb the inflation that we have? I don't think so. I think it's going to continue to have to go up from there. Obviously, not financial advice, but it's something where there's an enormous amount of inflation still in the system. What was the print last month for the CPI? 9%.
9.1, yeah.
9.1. Like 3% is not going to do that. It's something where it feels like people are just, clinging to the days of 2021 and they're looking for any good news in the market. And this could be their
Right.
chance to, have a little fun. Like you're talking about, Zoe, like take the month of August to grind upwards and, play in the market. And then we're going to come back to reality and we're going to come back to CPI prints of still, probably pretty high. And it's a question of where does the Fed go from there? So I don't know. I think there's a 3% target, but that's just like everything that the Fed says, like that message can change and that can become 4% really quick. So, it feels like there's kind of a gap between in reality between like the numbers that we're hearing at the moment and the recent activity that we've seen in the last couple weeks here.
When
Mhm.
the other
It's a great point because I mean it's been a long while since we've seen some pretty good surges, right?
Right.
So people are probably just a little bit tired of it. What were you about to say, Sia?
No, I saw him. You want to go ahead and share this?
Yeah, I was just gonna say on the topic of the inflation, I know Ev, you mentioned PCE. That's actually, I believe, yeah, coming tomorrow morning, right?
Okay.
And the key here with PCE, it's not as popular as like CPI and stuff, but what it does give you is an insight because it's on the producer side, it's producer inflation, right? And so a lot of times what happens is producers experience the inflation first and then end up passing it on to consumers later, right? And so a lot of times you can see from the PCE, from the producer side, kind of a telescope into what you could imagine to see for CPI later down the line.
Right.
Right.
Maybe a forecast.
Yeah, exactly. So you might be able to. So they're predicting 6.3 tomorrow. We'll see where it comes in at. But if that comes in low, which it seems like the prediction is low compared to what it was last month and stuff, right? Like it was coming in the sevens. So people are already betting that it's going to go down. So that's going to be really interesting to see because if that goes down and if it even is less than 6.3, then that's going to start really, pretty much validating what people are feeling in terms of like, okay, this might be peak inflation like last month, like that sort of feeling. So something to keep an eye on. 8:30 a.m. tomorrow morning. We'll see where that comes in at. And then, of course, our favorite, UMich customer sentiment, probably still in the dumps, but
Hey, it bumped the last time, so we'll see, right? We'll see.
But
I mean, I think it's a little bit interesting, right? It's like, I mean, we'll definitely go into the flows here in a second, but we continued to see a lot of the short Bitcoin happening. So a little bit of this makes me also think like or people or institutions, et cetera, were predicting like, okay, we have this massive print coming, right? And we have GDP coming out, like everything's going to tank, right? So maybe some of these shorts are just being liquidated a little bit. So maybe that's something that's driving it. I don't know. I don't know if you have any thoughts on that, but
no, but I think like the other thing, just to piggyback off of what Zoe was saying, just in terms of like and Ev about like the way that the Fed could react. I think another reason why it was a little bit more bullish than we expected, even with the 75 BIP, it was that apparently this was basically like we've finally reached the estimate level of a neutral rate. So what a neutral interest rate means is nominally, like they've basically reached a point where they're no longer actively overheating the market. So with how low interest rates were the last 5-10 years ish, they were actually actively overheat. Like they aren't overheating it in the beginning, right? But by this year they were overheating it. And so he was saying, this is Powell, he was saying like we're now at levels broadly in line with our estimates for neutral interest rates. And after front loading our hiking cycle until now, we'll be much more data dependent, which is what we were talking about before. So basically they're like on like level playing field now. So anything they do more is actively trying to restrict the economy. So actually trying to excessively cool it down. But up until this point, they basically just caught up with how low the interest rates have been. And they basically got to that point quicker than they expected. So like that's another thing that people were saying is I mean, not bullish, but more so of a more confidence in what the Fed's doing.
It's also interesting too, because when we look at some of these numbers that came out from the GDP, we actually saw like with inflation adjusted, we saw consumer spending expand by 1%, which is it's almost kind of a factor of you can see that people still have money on their balance sheets, like in their household balance sheets, and they want the same economy that we had in 2021 to keep going. So yeah, it'll be interesting to see. Like that's a number that you could see where they would restrict the economy a little bit and consumer spending would decrease. So I thought that was still pretty interesting. Just talking about bullish points that came out of this last week. Expanded 1% of consumer spending, along with what you're saying, Sia.
That's cool. That's a really good point.
Should we roll into the fund flows?
Yeah, let's hop into the updated fund flows. We always do this. So we'll just cap it off with this. This is volume 90. So this came out, what was it, 3 days ago at this point. As we saw last week, it actually got a little bit edited. So the inflows at the end of the week were super, super drastic. They corrected it to 206 million, which is fairly drastic. So if I go over here to volume 89, you can see kind of where it was at prior. This is the one we're looking at.
It was literally at 0.
Yeah, and now we're looking at it up and over 300, right? So pretty drastic correction there. I don't know exactly when James does this, but I think it's still super helpful for us just to kind of, as a lagging indicator, understand where some of the institutions are putting their money. So if we come down here, Bitcoin's now up to 241.3 million for year-to-date flows, which is pretty extravagant, with the month to date obviously being a majority of what's been inflowing in there for the year. So tons of money has been coming into Bitcoin. I'm sure you all have been seeing all the news about Ethereum. A good amount of money has been coming into Ethereum. The year-to-date flows are still pretty negative from an institutional perspective, but they got hit pretty dang hard there for the first 5-6 months of the year. So pretty good from the Ethereum perspective there. But I also noticed was Bitcoin shorting went down, which was kind of constantly going up, I feel like, for the last couple of weeks that we were looking at this. And another interesting one, people are starting to get a little risky, right? I mean, 1.8 million into Solana, 1.4 into Cardano. Like, I mean, people are feeling a little bit risk on these days. So some good news, I guess, in that sense from some of these institutions. And they think at least for the medium term, it seems like, or maybe if you would consider it the short term, it's all going to be kind of going up here for a little bit. So any thoughts on this?
Yeah, I mean, the last time we looked at this, I wasn't here last week, but the week before, when we saw when I brought up the point of the pair trade, the short Bitcoin, long Ethereum pair trade, for anybody who put that on 2 weeks ago, I applaud you, because that trade is absolutely fucking printing right now.
Yeah, I wish I had.
Like we have Ethereum up like 60-70%, Bitcoin up probably like 20% in that same time. So like, and you definitely hedged the downside too, had some shit gone wrong with the Fed meeting and stuff. Applaud that trade for sure. That was a really good trade. If anybody actually even put that on, this is all speculation, right? Yeah, it is kind of interesting. People maybe taking a little bit of like risk reward perspective here, going down the risk curve a little bit, throwing in Solana, Cardano. Let's say like you had your institution, you had like, I don't know, 20 million to deploy or something like that, 10 million to deploy, throwing a small percentage of that relative, into some of these higher risk plays. If we do see a rally, could print like an outsized return. So like that makes sense. I agree with everything else you said though. Like,
yeah, I mean, it's interesting. It's the largest inflow we've seen since.
I mean, that correction is absolutely wild, and that totally makes sense.
Yeah, we were kind of like, what's going on? Who's buying? Right. I think that's what we were saying last week. It's like, I mean, institutions and big money moves the market. So like, if they're not,
I think
buying,
we talked about that. I think we said if we don't see anything on this next week, then it was retail driving the price. Obviously, institution had a hand to play in it. And we just caught it late from Jimbo. But no, I think it's interesting. It feels like we've kind of moved past the Three Arrows saga, and it feels like there hasn't been any news out of that in the last week, which is, very exciting. I'm glad no more, centralized CeFi banks are going under. I think we've had enough of the share for the summer. But yeah, it feels like we've got far less bearish news going on, and that could be a big reason why institutions want to hop back in.
How about Switzerland right here, just aping in?
Yeah. Oh, actually, yeah. Switzerland and Germany.
Wow.
Jeez.
Dang.
Gotta love it.
Go. Oh, that's
Anyways.
wait, so they've in their total under management, they've basically put a third in of that this year alone of what they own on and
I
all
feel
of
like
crypto.
this is just like Swiss bank accounts for like
Okay.
just mega heads. I don't know.
Okay.
That's just like I have no idea, but like it just feels like that would be that, you know?
Yeah.
Do you think Do Kwon's got a few Swiss accounts?
Probably. He's got to pay for those lawsuits somehow.
Oh man. So Quan, I haven't heard that name in a minute.
Yeah. R.I.P. to the man. He ain't dead, but he's struggling.
He's struggling.
All right, boys. Well, that'll do it for this week. To the fans, thank you so much for tuning back in to another episode. If you found any of this useful, definitely like, subscribe, and comment down below. We'd love to hear from everyone, all the people that tune in every week. Apart from that, like we'll be back same time, same place next week.
Covering
Yeah.
Uniswap.
Uniswap
Yeah.
next
Covering
week.
Uniswap, baby.
Uniswap next week.
Excited for it.
Wag me.
Wag me, fam.
Yep. Later.
Signing off.
Later.
Peace.